I think we are live. Morning, Facebook. Hope you are doing well. So today we are going to talk about how to rock at risk management. Sounds a bit of a cheesy title. The reason I picked that is because when was it? This Monday I was doing a presentation for a broker out in Scandinavia and about 150 of their clients, and I was talking about how to do or how to create and how to put in place a rock solid risk management strategy. Now, the thing with something like that is a lot of people, especially people who've traded before, they think that setting up a risk management strategy is about having tight stops. It is about making sure that they trail their stops on trades that are going in their direction. They think it's purely about minimizing their risk. And what I found from coaching people from different levels of experience and different disciplines in trading is most traders know from a rules-based perspective how to manage their risk. It's not something that they essentially struggle with. So what I wanted to do today, and I'm hoping I'm going to be able to get on my screen, but it doesn't look like I'm going to be able to do that. So I think I'm going to carry this on just talking to the camera. I was hoping I was going to be able to show my screen and show the camera, but I don't think I can. So I'll talk you through these factors so that you understand them. So one of the things that I said to the group at this particular summit on Monday was that you have to factor in three things when you're looking at a risk management strategy or a risk management process. You can't simply just look at stops and just leave it at that. So the three areas that I said you need to be focusing on are rules and procedures. So you have to have a set of rules and procedures around what you risk, what you stake, and the process by which you set your trade management up, whether you do or don't move your stops. Second one is that has to be data orientated because, as I said, a lot of traders know exactly what they should be doing in terms of the amount they should risk. But then what happens is the trade that they're in lasts for 2 or 3 days longer than planned. Or like currently, I'm in 3 trades that I've been in for nearly a month and they've neither hit my stop or hit my target. The risk in those situations is that the trader changes their risk profile, gets out the trades too soon, um, tries to basically meddle with the trades and ends up risking more or changing the parameters of the trade. So knowing the data behind what you're doing is very important. I see a lot of traders that on a couple of winning or losing trades, they suddenly change their stakes. So I'll talk about that in a minute. And then lastly is the psychology. The psychology is so important around risk. People think psychology is just something you work on, but risk, psychology, trade execution, all of the factors. If you think about the TSC 4 pillars, which is strategy combined with discretion, risk management, data, and mindset, all of those interact with each other. And if one of them isn't working, that can have a knock on effect on the others. So if we think about rules, here are 3 or 4 key things within terms of rules and procedures that any risk management plan has to have in place. So the first one is always use a stop. Okay, I hear traders use all kinds of excuses. So they'll say that they use a mental stop loss, that they have got a stop loss, but they haven't actually got it in. But if price reaches that level, they will get out. Well, that's just craziness. So always use a stop and make sure that all of your testing revolves around using a stop. You can optimize that level, but you must test and you must track your trades and use a stop. Second rule, never widen a stop once you're in the trade. I've seen traders that have been in 2 positions at once, possibly even 3, and what's happened is one of those 3 trades has lost, and then they've gone into one of the active trades and they've moved their stop, and they're doing that because they don't want to have 2 losers. And we'll talk about this from a psychological point of view in a minute. So they end up widening or manipulating their stop or changing their stop and increasing their risk because what they don't want to do or what they're trying to do is avoid another loser rather than simply sticking to the plan. So always have a stop. Once you're in a trade, never widen that stop. Then another one. Um, Key is, regardless of the strategy you trade, what you must do is make sure within that strategy that you have a designated percentage risk for that particular trade that is related to data. Now, I was hoping I was going to be able to show you some charts but at the moment I can only show the camera. So at some point I will do this because I think it's a really important element that you guys need to see. So you can see some of our live data, some of our back tested data. Now, for example, our first day of the month strategy, which we're trading tonight, that is a strategy that we only trade once a month. So essentially there's 12 opportunities to trade during the period of 1 year. So in terms of trade frequency, which is another element that we measure, in terms of trade frequency, I'm only trading 12 times in 1 year. So we have tested and can afford to have a higher percentage risk on each trade that's placed. So on that particular strategy, the maximum risk per trade that we run is 2.5% of the total account value. So if you imagine your account value, imagine your account as having 100 gold coins. 2.5 of those gold coins get risked on one of those trades. And we can risk more on that strategy, 2.5% per trade, because the trade frequency is that much lower, because that's the set of strategy rules. Whereas the guys in our day trading room that are working with Kerry, or the guys that are trading with Martin in the morning, they may be risking half, sometimes even 0.25% per trade, because they may end up placing more trades in one day than the guys who are trading our beat the bank strategy, the first day of the month trade, trade in an entire year. They could end up trading 12 times in one day. So their percentage risk, if you think back to your gold coins, their 100 gold coins, they might be risking a third of one coin on each trade, because they need to be risking less because their trade frequency is higher. If they were to risk 2% or 2.5% on each trade and have a bad day, in the space of 24 hours, they could wipe out a big chunk of their account. Whereas that is not going to happen on our position-based strategy, our first day of the month strategy, because it's going to take 12 months before you accumulate the same number of trades. So the percentage you risk needs to be predefined, and it needs to be tested, and it needs to be qualified. And they're just a couple of simple, basic rules and procedures that apply regardless of the type of trade that you have. Always use a stop, never widen a stop, and make sure you have a predetermined risk on that trade. A couple of subtle things to add to that is, don't increase the risk. So if you've maxed it at 1% per trade, don't increase the risk because you have had two losing trades and you want to get back your loss. Don't increase the risk because you think that that particular trade has got more chance of winning, or because it's a setup that is on one of your two strategies, and that strategy actually gives you a better win-loss ratio. Now that win-loss ratio might be over a year, so risking extra on one trade because over a year that strategy does better than the other strategy, again, is a big mistake. And then lastly, we'll touch on this in a minute, don't simply move stops into to break even, or don't move stops in and trail stops up to lock in profit simply because you feel like it. I see traders do this. I see traders have very often too tighter stops because they think they are preventing risk. But actually, by having the stop too close to their entry, what they're doing is they're putting themselves at more risk because they end up having more losing trades and they haven't given that trade room to breathe. So they're moving their stop to break even too quick, or they're starting with stops too tight. And this is something I did after I lost money initially. So I lost money initially recklessly. My response was to be more cautious, and I thought that by having my stops really tight, I was actually preventing myself from taking risk, and my risk management was good. But in fact, my stops were too tight. I didn't give my trades room to breathe. So how do you know where you should be putting your stop? Well, it comes to the second element of risk management, and that is data. So data is so important, and I will, on another video, I'll show you some of the data. So we'll do it as a screen video because I want you to see the power of having 100, 200, in some cases 300, 400 trades worth of data in front of you on a spreadsheet. So one of the things that you can look at once you've got that data is you can look at both the upside and the downside. Too many traders set their trade management process and routine up based on the fact that they think they're going to be winning 80% of the time. And there may well be periods during a year or 2 years where they are winning 80, 90% of the time. But there are also going to be periods, sometimes shorter, sometimes longer, where they could be losing 80% of the time. And as a result, their risk management processes and their rules and procedures need to account for that. So any risk management process you have has got to work in the worst times, not just in the best times. Okay, so you have to assume the worst, that you could be losing 80% of the time. So does your risk management, your stakes, your stops allow your strategy to cope with that? Because I've seen good traders with good strategies, but their risk management profile has been too optimistic. And then what happens is they burn too much of their account, and then it takes them a year, 2 years to get back to where they started. And if they'd just come to me sooner and they'd been able to run the right risk profile and been a little bit less greedy from the offset, they would be in a position where they were able to capitalize. So what happens is they get on a winning run, but because they've lost so much, that winning run is just getting them back to break even instead of maximizing their profit opportunity. So you have to assume that when you come out the gate, just because you've got a strategy that works over a year or 2 years, when you come out of the gate, you might be the person that hits the losing period when you start. And being able to go through the data and look at that is really important. So I'll do another video on data elements because I think that will really help. So you've got to prepare for the best and the worst. You've got to look at things like worst performing period. So look at the worst performing period, and that's a combination of winners and losers. Look at the best performing period, combination of winners and losers. Prepare yourself for the longest winning run. So let's say you've got 5 winners on the trot. You may get out there and trade the strategy, and that maximum gets broken. But you may have 6 losing trades on the trot. So prepare for that, or even worse, and create your management plan accordingly. And this is something that I do. And we have different risk management profiles for different types of strategies, day, swing, position. But within swing trading, we may adopt a different plan depending on the strategy that we're trading, because not all of our swing traders trade one strategy. They might trade 3 strategies within their swing trading profile. So a big one, trade frequency. So measure trade frequency in 2 ways. Firstly, the number of trades you have over a period of time. And I've mentioned that already in this video. So you might have, with our position-based strategy, a maximum of 12 trades or 12 setups in 1 year. Or if you're a day trader, you might have that within a week or even a couple of days. So understand how often you are trading, but also look at it in more detail. How many trades are you running at one time? Because that can impact what happens. But also think about how long you're in trades for, because I see this affect traders, as I've already said. If you know that the average time for one of your swing trades is 6 days, but you know that there are times where you could be in a trade for a month, could be in a trade for 6 weeks. If you're in a trade that runs for a longer period of time, like I am, I'm not tempted to fiddle around with my stops or change what I'm doing or get out early, because I know that being in that trade for that period of time is not only a possibility, but also there is no direct impact between being in the trade for a long period of time and getting the trade losing. So essentially the trade can win or lose regardless of whether I'm in it for a month or 6 weeks, or even on some of my swing trades 6 hours. We had a couple of swing trades only a few months ago that we were in and out within 6 hours. That bit we can't control, how long that trade's going to take, but we can track the data for it. And then lastly, I would say have a think about psychology as well. So think about preparing yourself for the long term. I see too many traders change their risk management process because they are too transfixed on whether the trade they're in now or the last couple of trades that they have been in were winners or losers. So you have to move away from being right or wrong on trades, winning and losing on trades, to did I follow my process correctly? And the psychology of that takes time, and different traders, because of their personality styles, come at that from different angles. So having somebody there to give you feedback and make you aware of where your strengths and weaknesses are from a psychological point of view can really help. And this is where in my trading room sometimes I will coach two traders who are in a similar strategy, similar trade. I'll coach them in different ways because I know that one is more fear orientated, one is more greed orientated. So the idea is to work your psychology and bring it back, bring your extremes of fear and greed closer to the middle so you are making more objective decisions. So be aware of how much your psychology and the short-term results that you have had either that week or that month can impact what you do. Very simply, if you've had 3 or 4 losers, some traders' response to that will be to pull away from the market and be wary about taking another trade because they don't want to risk more money. But the fact that they are pulling away, they've had 3 or 4 losers. If they were to check their data and say that only happens every 2 or 3 months where you get a run of losing trades to that extreme, they should now be coming in and continuing to place trades. So by not trading, they're taking more risk, but they've pulled away because they're risk averse. The opposite can occur if a trader is greed orientated, is if they've had 3 or 4 losers, what they then do is they start placing more trades, so you see their trade frequency go up, or what happens is they increase their risk. So they go from risking 1% on a trade to risking 2 because they psychologically kid themselves and saying, well, if I have 2 winners now, then I'll make back all of my losses and I'll be back in profit. So be wary of how the short-term result affects your actions or inactions. So all of these 3 factors make up a good, solid risk management strategy and process, which is rules and procedures, data, and psychology. Good. That's all I got for today. Hope that was useful, and I'll catch up with you again soon.